Hi, my name is Randy Turner. I'm an agent here at Ashley Lay Real Estate, Keller Williams Elite, and we are here to talk a little bit about mortgages and mortgage rates and what's going on for financing, people who need financing help to make those kind of purchases. And I'm joined here by Sam Collier. And Sam, why don't you introduce yourself? Tell us a bit about you.
I'm Sam Collier with McLean Mortgage. I'm a loan officer. Some people refer to me as a lender or a mortgage loan originator. You can use those terms interchangeably. But I help people get approved for financing on primary residences, second homes, and investment properties. So pretty simple. If you're looking to buy a home and you're not paying cash, you would come to me.
Great. So Sam, the real estate market's been really hot the last couple of years. And part of that's been driven by low interest rates. So how's that impacted your business over these 2 years?
Yeah, so, interest rate is going to have a big effect on your monthly payment. So although it's being equal, a lower rate is going to mean a lower monthly payment, which means you can get approved for, more purchasing power in a higher priced house that otherwise you wouldn't be able to. So what we've seen over the last couple of years is with that, the pool of buyers has expanded. People maybe 3 or 4 years ago when rates were approaching 5%, if they could only get approved for a $200,000 home, maybe now they can go up to $250,000. So competition's a lot more fierce. You have people who otherwise would not be talking about real estate at all. Friends, family, I call it the taxi cab effect. The old adage, you take a taxi in the city and your cab driver starts talking to you about a hot stock tip,
right.
How he day trades and stuff like that. It's kind of the same thing with real estate. People hear all this chitter chatter about rates getting low, and now, their ears perk up and they start becoming interested and invested. And a lot of them are refinancing, right? So if they bought their home years ago, they, re-amortize that loan. Now their payment's in half. Now maybe they can afford to buy a second home. With COVID, you have a bunch of people working remotely now. What do? They buy a beach house. They buy a vacation home. They buy an Airbnb. People are scratching the itch. They're doing home renovations. They're doing cash out refinances. So how that's affected us with that refi volume, a lot of those refis need appraisals. So it's taken up our appraisers. It's hard to get an appraisal done in the normal 1 to 2 week period that we used to be able to do. Homeowners insurance, everyone's got to get their policy renewed. It's hard for us to get our purchase business through. So there was actually a point in time in 2020 when a lot of your big box and online internet lenders completely cut off the refinances because they quite literally couldn't handle the volume. So
wow.
Been crazy.
Yeah, so overall, would you say that's been a good thing or a bad thing, these low interest rates for the mortgage industry?
Depends on your perspective, depends on who's asking. If you're a buyer and you can get in a home, it's been great, right? You get the lowest monthly payment possible, but with that, there are drawbacks as well. There's more competition. With that increased rate volume, luckily I have an awesome team. We didn't miss a beat. We had our best year ever. But for some other loan officers who didn't have that team in place or maybe didn't have the support staff to handle it, they had a really hard time delivering the same level of service that is custom for purchase business. So there's pros and cons to every situation, good and bad.
Right. So now that we've rounded the corner into 2022, things are shifting a little bit and interest rates are beginning to trend upward already, a modest increase. We expect to see 3, 4 more of those this next year. How does that reshape what the rest of the year might look like for those interested in mortgages?
So, like I said before, lower rates means lower monthly payments. So therefore, higher rates means higher payments. So, if you're a buyer, you're not going to be able to get approved for as much as you would be when rates were low, but you'll probably have less competition. Our experience has been rates go up and down all the time, year to year. That in and of itself typically doesn't affect buyer demand per se as much. It just affects, the price range that they can look in. So if you're a buyer, you're not going to be able to get approved for as much, but whatever your sweet spot is in your price range, you're probably going to have less competition. If you're a seller, same thing, your buyer pool is going to shrink. So right now is the time to buy or sell, either or.
So one of the things we were talking about before we began this interview is the concept of people live in the monthly payment. expand on what that means.
A lot of people, when I go to pre-approve them, the first question they ask, what's my max? You know, what's the absolute highest dollar amount I can get approved for? What's my max purchase price? And I can obviously give you a range of where you need to look in, but in terms of your literal dollar absolute max, that's kind of a moving target, you know, because you're not getting approved for a purchase price, you're getting approved for a housing payment. So think about what goes into a housing payment: principal, interest, taxes, insurance, mortgage insurance, and HOA dues. Some houses have HOA dues, some don't. If you're looking at townhomes or condos, that could differ by a couple $100, you know, from house to house. You might be able to get approved for a $150,000 single family home, but not a $150,000 condo because of those HOA dues. If you're looking in within city limits where the property taxes are a little bit higher than a more rural area, you have to look at things like that, because that at the end of the day is what you're getting approved for. So rather than ask, you know, what is my maximum purchase price, you should probably figure out what's my maximum housing payment, and then from there reverse engineer what purchase price you need to be looking in. And depending on when you're putting in offers, you know, if you're 3-6 months away, you know, that number is going to change too, because rates might go up or down from then, and that number is going to change.
Gotcha. Makes sense. So with rates increasing, how should people develop a strategy to think about things like closing costs when they're looking at making a home purchase?
Yeah, save money. Save as much money as possible. Sell your car, get a gift from mom and dad, do whatever you got to do, because right now, you know, the down payment assistance, the low and no money down, the low credit government loans, they're just not competitive right now. And if you want to put yourself in the best position possible to get in a home in general, but also, you know, the home that you want, you need to do what you got to do to compete against the 10 or 20 other offers you're going up against. Some of them might be cash, and sellers are unwilling to pay closing costs. They're unwilling to make appraisal concessions. They're unwilling to make unnecessary repairs because they don't have to. It's just simple supply and demand. So my advice is get pre-approved early as possible. If you think you even may have the inclination to buy a home anytime this year, go ahead and do it. Fill out an application, submit your income documentation, because I can't tell you how many times I hear people say, oh, we're not looking, you know, our lease doesn't run out for 6 months, and then I get a text on Saturday morning, hey, we're going to see this property today, we fell in love, can I get a pre-approval letter? And, you know, I can do it, but it's always way more fun if I have, you know, more time.
Yeah. So how long does a pre-approval last? Is there a period that runs out or expires?
Yeah, so your credit report's good for 120 days. The pre-approval itself really lasts for as long as your financial situation stays the same. So don't switch jobs, don't spend your down payment money, don't open a new credit card, don't buy a new car, don't change anything about your credit profile. At the end of 120 days, if you're not in a home yet, I have to refresh your credit report. If you haven't done anything major, haven't made any late payments, you know, hopefully your credit score should be the same. But that's what I tell people.
Yeah. So roughly every 4 months or so?
3 to 4 months, yeah. I like to touch base, you know, every couple weeks just to make sure, because even though I tell people to do that, they don't always listen, as I'm sure we all know.
Yeah.
But, you know, my biggest piece of advice would be get pre-approved early and get connected with a good quality realtor, because, you know, it's a tough waters to navigate out there right now, especially if you're trying to do it on your own or someone that's not as experienced. So
it sounds like the home buyers and prospective home buyers do the best job when they're best prepared.
100%.
Right? Yeah.
100%. Yeah.
Yeah. So the phenomena that we've seen of due diligence and the large amounts of due diligence, you see any changes in that over the next year?
It's been going up, man. I mean, you know, the Fed's announced that they are going to be tapering their purchase of mortgage-backed securities. That's what affects mortgage rates. A lot of people hear about the Fed, raising and lowering interest rates, most of the time what they're talking about is the Fed funds rate. That's short-term borrowing, auto loans, credit cards, or the cost of banks to borrow from each other. What affects mortgage rates is actually the 10-year Treasury bond, and the Fed can indirectly affect that if they buy and sell mortgage-backed securities. So, the reason rates shot down was people were taking money out of the stock market, buying up all the bonds, that drives the yield down. But that's why we're seeing a slow increase in rates lately. They're slowly tapering off that buying. So what we expect that, depending on who you ask, quell inflation a little bit. Rates are going to rise slowly, enough for people to adjust and absorb the shock. So that might have a slight effect on the buyer pool if they get priced out. But at the same time, in my opinion, the biggest driver of the insanity we're seeing with the due diligence and the multiple offers on every home is just lack of supply. It really is that simple. And depending on who you ask, countrywide, we're millions of homes short in inventory, and that's not going to pop up overnight. So even if we do get a solid influx of inventory, that's months to years out. Even if rates do rise and competition slows down a little bit, I don't see it swinging in favor of buyers for the foreseeable future. I mean, we're talking years down the road. So with that said, no one has a crystal ball. People are always hesitant to, when they see rates increasing, it can be a little bit discouraging. But a beacon of hope would be, if rates continue to go up, lock in now. That means you got a good deal. If you lock in now and they go down, you can refinance. So win-win. I would say pull the trigger whenever you're ready.
Yeah, so there are some people who are going to be watching this who are first-time home buyers, or prospective first-time home buyers. We don't want to discourage them, right, from getting into the process. For sure. So in all of this, what's the encouraging thing for those people?
The encouraging thing I would say is, we expect there to be a slower increase, but still an increase in appreciation and demand. So if you buy a home now, you're very likely to make money on it, even if you feel that you're overpaying. Don't get in over your head. You know, it's really hard to do that these days. It's really hard to get approved for more than you can handle financially, I think, because of the way the mortgage guidelines are written. We do a good job of keeping people in a comfortable range with their monthly payment. But I don't think anyone who buys a home in the next few years will lose money in the long term.
Okay. So that takes me to another question I wanted to talk about is, some people are sitting on the fence about selling their home. A couple of reasons. One is, where will I move if I sell my home? The other thing is, I may sell my home at top dollar, but I'm also going to buy a replacement home at top dollar. But life changes. People need to downsize. Sure. People's jobs change. They need to upsize their home. All kinds of reasons that people may need to do that. So for people who are just sitting on the fence, waiting for it to become more favorable either for the buyer or the seller, what's your advice to them?
So one of my favorite quotes, this has more to do with stocks and financial markets, but I don't know if you've ever heard the phrase, markets can remain irrational longer than you can remain solvent. I think the same applies to the situation. If you're a seller, make hay while the sun shines. You're never going to get more money for your home than you will right now. And if rates increase and if inflation continues to increase and if buyers can't get approved for as much as they can now, your pool of buyers is going to shrink, and with that, so will the number of offers. So I think a part of the problem with that line of thinking, it's a bit of a self-fulfilling prophecy, right? There's no inventory because everyone thinks there's no inventory and they just kind of feed off each other. So we need a couple brave souls out there to go ahead and put their homes on the market because we got plenty of buyers for them.
Yeah. So you and I were talking a couple of weeks ago about interest rates and this specter of interest rates rising, but we're still at historic levels of low interest rates. The age I am, I remember my first home purchase. We got a variable rate interest, and it started out at 12%, and it could have gone up to 18% before it would have capped out. In 1979, I think we got that loan. That's a lot of money in interest, right? Compared to what people are looking at financing.
Yeah, it's recency bias, right? Everyone's spoiled. Everyone's heard chatter of the 2s and 3s
Yes.
from 2020 and 2021. So relative to that, yes, they're higher. But if you look at a historical and global perspective, it's still, the cheapest money you can get. Borrow at high 3s, low 4s for 30 years. I mean, inflation. The latest report I saw, inflation was at 7.5%. That's free money.
Yeah.
If you can get a 30-year mortgage, even if it's in the high 3s, I'll take that all day. My parents, their first home was 12% as well. So,
yeah. So, anything else you'd like to say to our viewers?
That's it. My word of advice: get with a realtor, get with a lender. Go ahead and get the ball rolling because I see it all the time. People try to scramble last minute to get an offer in. They don't have their ducks in a row, and they either lose out on the home that they wanted, or they cause themselves unnecessary stress.
Yeah.
So.
Yeah. So it may be true that the best realtors are those who have the best resources. People like Sam who can help answer questions and who can help you get past those hurdles. So at Ashley Realty, you'll find lots of resources, and we hope you'll consider talking to us about how we can get you into the real estate that you're looking for, whether it's that second home or if you're wanting to sell or to buy. So thanks for watching today.